Copyright in these lectures is either owned by the ANU or a third party who has licensed the ANU to use it. Students may use the recording for personal study only. No lecture may be communicated online, copied or shared without the prior permission of the ANU.
Okay, everyone, I think we can get started. So before we go to the course material today, again, there are something I think good for you, okay? If you are looking for internship during the summer break, okay, you can actually try the Chartered Accountant Summer Achiever Program, okay? So I put the details on Water already. If you're interested in, please have a look at the materials and and you can click the link to apply. Okay, so basically, this Achiever program open to both international or domestic students. Okay, it doesn't matter which year you are in. Okay, so if you are in your final year or you are in your second year, you are more than welcome to apply. Okay, so the placement. Okay, so there will be a number of firms that join this Achiever program. They are looking for interns. Okay. And I can tell you, based on our past experience, if you got an internship from one of the firms, very likely you have to perform well, right? And very likely after graduation, you'll be employed. Okay. So if you're interested in, have a look at which firms join the Achiever program, and you can apply for one of them. Okay. So your work during the summer will be paid work, okay? So you are not working for free, okay? I think the application, already opened, and it will be closed on this weekend, okay? So if you click the slides over here, okay? The second slides actually tell you what's the process, okay, for the program. So you need to fill in an online application, all right, and then go through all the tests. And hopefully, if you're lucky and you pass all the tests and the interviews, you'll get your offer, okay, by end of September. All right? Okay. All right, so this is a reminder for your tutorials, okay? So for those who have not found a teammate for your assignment and the presentation, okay, you need to let your tutor know as soon as possible, okay? Because the presentation starts this week and the assignment will be due in week 6, okay? So you really need to find your teammate. If you are not sure who you are working with, okay, if you can't remember who your teammates, once again, please confirm with your tutor, okay? Now, if you have changed your tutorial enrollment, you have switched tutorial from one group to another, please let your previous tutor know and also let your new tutor know that you have switched, okay? All right, so what we are going to do today is to have a close look at normative theory, okay, and its application in accounting. So just a quick recap of what we did last week. We talked about theory, right? We talked about what theory is scientific theory and how do we falsify theory. And then at the end of last week, we talked about in accounting, there are two main streams, okay, of theories. So one stream is called positive theory and one stream is called normative theory, okay? So a number of topics that we covered in this course are on positive theory, which is based on your observation of the current practice, okay? But there are a few topics that we're going to talk about are related to normative theory, okay? So what is normative theory? It's very prescriptive, right? So it's prescription. It tells you what you should do, okay? Instead of observing what has been done in the current practice, all right? So this is something that we're going to talk about today, okay? So later on when you see we talk about those conceptual framework, okay? they are very normative, they are very prescriptive, okay? So if you look at today's topic, when we talk about conceptual framework, when we talk about how we develop accounting standards, okay, some of the material are quite dry because I guess most of people don't like other people to tell you what you should do, right? So we try to make this topic a little bit fun or playful for you by giving you some examples, okay, on the way. All right, so we are going to have a look at the conceptual framework, okay? So what do we mean by conceptual framework and how it is developed, okay? And we are going to talk about some measurement issues in accounting, okay? And it's related to the conceptual framework. It is actually one thing that the current conceptual work has not addressed, okay? And related to the measurement in accounting, we are going to touch a little bit on the alternative valuation models, okay? So the alternative valuation models are going to be discussed in week 11 and week 12 in more details, okay? And these models are I think that they are the only topics that involve calculations, okay? So you would expect to do some calculations when we talk about these valuation models, okay? But we're only going to touch a little bit on it. So let's begin with the conceptual framework. Okay, now I think you've probably heard conceptual framework before, right? In your past studies, right? So recall your memory of, let's say, BUSN 708. When we define an asset, when we define a liability, we talk about conceptual framework, right? In Australia, remember? Yes? Probably not. Okay, so what do we mean by that? Okay, so conceptual framework basically are core assumptions. Okay, so these are the core assumptions regarding the purpose of accounting, the identity of its users, and the nature of financial items. Okay, so we talked about last week, right? When we form a theory, we have to agree on something first. So these are called primitive terms. Remember that? So it's very similar here, okay? Before we can develop our accounting standards, the users or the stakeholders, they need to agree upon some core assumptions before they can move on, okay? So these core assumptions are related to why do we need accounting, right? So if the stakeholders, the major stakeholders cannot agree on why do we need accounting, then we don't need accounting, right? So we have to agree on what's the purpose of accounting. And then we have to agree on who are the users. Okay, so who will use the information, the accounting information, right? So that's the identity of its users. And then we have to agree on what's the nature of financial items, okay, that we are going to provide information on. So the last bit here talks about what information is important and what information is considered as useful by the users. Making sense? Yeah? Now, as you can see, if one of the assumptions here changed, okay, consequently, your accounting standards will be changed. Making sense? So let me give you an example, okay? So I set rules for my tutorials, right? For example, but what's my basic assumption? My basic assumption is that all my tutors need to be fair, okay? Need to be fair to students, and they need to be perceived as fair by students, okay? So tutors need to be fair in their mind, and they need to be fair in appearance, okay? So other students' perception about their fairness is also important. So these two are my core assumptions, okay? Now, because I have these two core assumptions, then I develop rules for my tutors. Okay, so first of all, the tutor cannot accept any gift given by a current student which has a value greater than, let's say, $100. Okay, or if the tutor has a friend in the class, okay, they need to disclose, they need to declare, because other people may see the tutor and the friend are very close, so there will be a conflict of interest. Making sense? So these are the two rules that I developed to meet my core assumptions, okay? Now, if I'm telling you that now I change my core assumption, okay? So I only require my tutor to be fair in mind, okay? But other people's perception is not our consideration. We don't care what other students think about the fairness of the tutor. The tutor only needs to be fair in his or her own mind, okay? Then I change my rules accordingly, okay? So if the tutor has a friend in a class, it's okay as long as the tutor can justify he or she is fair, okay? Does that make sense? So I can remove my second rule and I only stick to the first rule if you cannot accept a gift for more than $100. Okay, so every time, so this also applies to the conceptual framework, okay? Every time when we change the core assumptions, we have to change the accounting standard accordingly. Okay, so having said that, accounting standards are derived from these core assumptions. All good? Yep. So these are conceptual framework, okay? Now, let's talk about how conceptual framework is developed. Okay, so it's an ongoing project. Now, before we adopt to international accounting standards, okay, back in 2005, so before 2005, conceptual framework were actually developed in a number of jurisdictions, okay? So every country at that time, they had their own conceptual framework. They had their own core assumptions about the purpose of accounting, the identity of the users, and also the nature of the financial information, okay? So this is what it used to be, okay? Every jurisdiction have their own conceptual frameworks, okay? Now, none of the conceptual framework actually was completed, okay? And it's also the case now because conceptual framework is an ongoing project. Okay, and then later on you can see we still have problems with the current conceptual framework, and these are something that need to be developed in future. Okay, so after 2005, many countries adopt the IFRS, so they adopting the international accounting standards, right? But before they do that, as we said, accounting standards is actually derived from the conceptual framework. Therefore, these countries who choose to adopt international accounting standards, they then have to adopt the international conceptual framework, so the IASB conceptual framework over here, okay? With one exception, which is the United States, okay? So the conceptual framework in the United States is actually very mature at that time, okay? And Americans believe they have a better conceptual framework than all other countries, okay? And in fact, their conceptual framework heavily influenced a lot of countries' own conceptual framework, including Australia, including the international conceptual framework, okay? So I guess in the current practice, okay, so there are two big sets of conceptual framework. The one that used by the Americans, and the one is so-called the International Conceptual Framework, which has been adopted by many other countries, okay? Now we mentioned that no standard setters had developed a complete conceptual framework. This is because the management, I keep saying management, the measurement issues typically remained unaddressed, okay? And we are going to talk about what are the measurement issues later on, okay? So if we look at the IASB's conceptual framework, okay, it was issued in 1989, and it's partly revised in 2010, and the last year it revised again, okay? So start from the beginning of next year, we're going to have a new booklet called Conceptual Framework for Financial Reporting, you know, talk about the revised version of this conceptual framework, okay? So having said that, the conceptual framework that we are talking about today are still based on the old version, okay? But I can tell you there's not much difference, okay, between the old and the new. Okay, so let's talk about what happened in the United States, okay? So the United States, at that time, let's 40 or 50 years ago, was the most developed economy, right? So their accounting system at that time were considered to be the most developed, okay? Therefore, they had their own conceptual framework developed about that time, 1974, okay? So at that time, they issued 6 statements, okay? And these 6 statements are basically the 6 core assumptions, right? About why do we need accounting, and who are the users, and how we do things, how we should do things, okay? So all these 6 statements, well, 5 of the 6 statements are very normative in nature, okay? So they basically tell the users, okay, or the accountants, this is why we need accounting. This is why accounting is so important, okay? And these are the potential users and the users, for example. And this is how we should record assets, and this is how we should record liabilities, for example, okay? And these are the information that we consider is useful. So they tell the accountants or the users of this conceptual framework very clearly what you should do, okay, and who they are. So they are very normative, they're very prescriptive in nature, with one exception, okay? So this exception is the S-fact number 5, okay? So S-fact number 5 relating to the recognition and the measurement of the items that you're going to put on the financial statement, okay? So for example, how should you recognize an asset, and how you should measure an asset, and how you should measure a liability, okay? So this statement was largely descriptive of the current practice. And why is that? Because back then, people really didn't know what was the best measurement, okay, for those financial statement items. Remember that we mentioned last week, right? For the normative theory, we try to tell people what's the best way to do things. And in fact, when you look at what we've just discussed and also those accounting standards, we tell people what you should do, and this is because this is the best way we think this is the best way to treat certain item, okay? But back then, the 5th statement over here, okay, relating to the measurement, is very descriptive because at that time people didn't know what is the best way to measure those items, okay? So what they did, what the standard setter did, is they still observe what was the current practice at that time, so what are the different measurement methods used by accountants at that time, and then they summarize them into a booklet, okay? And they hope this booklet serves as a guidance to the accountants in terms of how they should measure those items on the financial statement, okay? Now, as you can see, it received lots of criticism, okay? Because all your other 5 statements are trying to tell people this is the best way of doing things, you should do this, okay? But then with the measurement, you tell people, well, this is what you are doing, and then you just follow what you have been doing, okay? So measurement was an issue at that time, and it's still an issue now, okay? So what are the future changes? Okay, so the Americans have a quite complete set of conceptual framework at that time, okay? And then in 2005, lots of countries start to adopt the international standards, accounting standards, right? So you can consider the whole world is actually divided into 2 big parts, right? So one big part, lots of countries, they form together. They not form together, but they join the international accounting standard boards, like UK, Australia, New Zealand, and lots of European countries, and also China, okay? And then the other side of the world, the Americans, they stick to their own accounting standards because they think they are the best, okay? So now you see there are 2 different conceptual frameworks, but because in 2005, people realized globalization is important, right? So they want to actually work together and to develop one common conceptual framework that can be used by both standard boards, okay? So in 2005, they have this joint project called Convergence Project, Okay, so the two boards, the FASB, which is from the United States, okay, FASB and IASB, they work together, okay? So since then, there's lots of discussion papers. So if you read those accounting standard related articles published after 2005, a lot of them are actually talking about the convergence project, okay? So what are the core assumptions that we need to put together, and what are the modifications, okay, that we need to make? So they want to achieve a common conceptual framework, but guess what? This project paused in 2010, okay? So why this project was paused? Simply because there are too many disagreements between the two large parties and also between smaller parties. So we said, even within the ISB, okay, lots of countries adopting ISB have their own interest. They had their own conceptual framework before joining ISB, therefore there's lots of disagreement, okay? And these cannot be coordinated, so the project was paused in 2010, okay? And then the ISB tried to restart the project in 2012, okay? Because if you cannot settle the conceptual framework, you can actually not develop the related accounting standards, right? We said at the beginning, conceptual framework has to go first, and then you derive your accounting standards from the conceptual framework, okay? If you cannot agree on the conceptual framework, you cannot address those issues in the accounting standards, okay? So ISB then said, we want to reactivate this project, but the United States said, you can't do it by yourself. We have other priorities. Okay, because Americans said we have a quite complete conceptual framework, because we cannot agree on a common basis, so then you develop your own. Okay, so in 2012, the project restarted, but it's the ISB only project. Okay, and then from 2012 to 2018, okay, so ISB revised its conceptual framework. Okay, so that's a little bit history about the conceptual framework that we see today. So now we talk about the United States, we talk about the International Standard Board. So let's go back to Australia, okay? So Australia, before the adoption of IASB, they actually had a quite complete set of conceptual framework. Okay, so Australia was heavily influenced by the United States. Okay, so a lot of things that we're going to discuss later is very compatible with the Americans' conceptual framework. Okay, so before the adoption, we have 5 core assumptions. Okay, under the conceptual framework. So these are SAC 1 to SAC 4. So SAC means Statement of Accounting Concepts. Okay. So if you look at these 4 statements, okay, the first one is the definition of the reporting entity, okay? So it basically is telling you who should report and who are the users, okay, of accounting. And SAC number 2, objectives of general purpose financial reporting. So now we are talking about why we need accounting, yeah? So that's the objective, that's the purpose of accounting. SAC 3, talk about qualitative characteristics of financial information. So what information is useful, right? And what information is important. For an accounting information or financial information to be important, what kind of characteristics it should have. Okay, so this is SAC 3. And SAC 4 talks about the definition and the recognition of the elements of financial statements. Okay, so what are the items that we should put on the financial statement? Making sense? So these are the 4 statements at that time. And Australia actually want to develop another statement on the measurement in financial accounting, but this statement was never released. Okay, it's a dead duck because the issues with the measurement, okay, in accounting. So as you can see, Australia's framework is quite complete, right? It tells you who are the users, what are the purpose of accounting, and what information considered to be useful, okay? Now, what happened to this, to the Australian conceptual framework, okay? after the adoption of the international standards, okay, Australia also adopted the ISB's conceptual framework, okay, but we don't adopt the full set, okay, because back in 2005, the international conceptual framework wasn't complete, okay, it wasn't as good as what we had earlier, okay, so what Australia did was they maintained SAC 1 and SAC 2. Okay, but then SAC 3 and SAC 4 was replaced by the international equivalents. Okay, so if we go back to the 4 sets, okay, so SAC 1 and SAC 2 retained at that time, simply because at that time the international conceptual framework have no SAC 1, SAC 2 equivalents. Okay, so at that time the International Standard Board do not have a definition on who should be the reporting entity. They do not have a statement about the objectives of general purpose financial reporting. Okay, but they do have SAC 3 and SAC 4 equivalents. Therefore, we replace our own SAC 3, SAC 4 with the international equivalents. Okay, so that's what happened in 2005. Okay, now in 2013, we replaced SAC 2 again. Okay, why? Because after the revision in 2012, I think, the international standard boards now have a very clear statement in terms of what's the objective of general purpose financial reporting. Okay, so SAC 2 was then replaced, but SAC 1 still remained. Okay, so the definition of reporting entity is still our old SAC 1. Okay, and we'll talk about that in a minute, okay? So if we look at SAC 1 to 4, right, and we can find the international equivalents for SAC 2 to SAC 3, but if you look at this, okay, SAC 1 starts from the definition of reporting entity. And then the other SAC 2, 3, and 4, they talk about some aspects of the financial reporting, right? But both Australians conceptual framework and the international conceptual framework, they don't actually define what is financial reporting. Yes? So you look at these statements, there's no definition of financial reporting. So the ASB and ISB, they have heavily regulated financial reporting without directly defining financial reporting, okay? But the definition of financial reporting is quite important, right? Because it's the fundamental assumption that we need to have. What is financial reporting before we can move on to other SACs? Making sense? So what do is we adopt the Americans' definition of financial reporting. Okay, so remember, Americans actually had 6 statements, and one of them is actually defining what is financial reporting. Okay? So the Americans defines the scope of financial reporting in their conceptual framework, okay? And this is the information to meet the common interest of external parties who cannot demand special purpose reports, okay? Now you see I highlight some words, right, because they're important. So first of all, financial reporting, okay, is information that you release to users, okay? And this information is released to meet the common interest of external parties, okay? So in other words, this information are not targeting internal parties, okay? And these information are not targeting individual external parties, okay? Instead, this information is targeting the common interest of external parties, okay? And these external parties are those who cannot demand special purpose report. Okay, so we talk about general purpose financial reports versus special purpose financial reports. Do we? In your previous studies? So the first question, what is general purpose financial reports? Where do you normally see them? In the annual reports, right? So there are 4 statements, basically, and then including other other supplementary notes, right? So you have balance sheet, you have income statement, cash flow statement, and also the statement of changes in owner's equity, right? So the 4 sets financial statement. So they are examples of general purpose financial reporting, okay? Now, what are the special purpose reports? Any idea? So by name, these reports are prepared for special purpose, right? So what are special purpose? For example, the managers, right, want to see a department's budget, okay? So a statement about a budget, let's say in 3 months, is a special purpose report, okay? Or if you are the lender, okay, you are a big financial institution and you have loan, you issued loan to this company, then you want to know whether this company is doing well for the first 6 months, then you can actually demand for an interim financial report, right? And this is a special purpose report, okay? And also if you are government, let's say a government agency, ATO, okay, you want to see whether the company's tax payment is in compliance with the taxation law, right? Then you can demand special purpose report on the tax payment of this company, okay? So not all the external parties will, well, I can say all the external parties can use general purpose financial report, but some of the parties, they can actually demand for special purpose reports, okay? Now you see I list some of the parties over here, okay? So these guys are the equity investors, large creditors, large trade unions, large customer and suppliers, and the government. So these are all external parties to the organization, but they can actually demand for special purpose reports, okay? Therefore, they are not these external parties we are talking in the scope of financial reporting over here. Making sense? No? Yes? Okay. Now, managers, of course, they are internal parties, okay? So they are not the external party we are talking in the definition, okay? So what we are saying is that the financial reports, the general purpose financial reports, therefore, should not be designed or may not be designed to meet the needs for these parties, okay, over here. Okay, so that's the definition of financial reporting, okay? So the financial reporting that we are talking about in conceptual framework is a general purpose financial reporting, okay? Now, let's have a look at the conceptual framework that we have currently, okay? So we begin with SAC number 1. So SAC number 1 is on the definition of the reporting entity, okay? Remember, this is the only SAC or the original SAC that we retained in Australia because international conceptual framework does not have this definition of the reporting entity, okay? So SAC 1 defines who should be a reporting entity, okay? So this is an entity that has users that dependent on the general purpose financial reports for information to facilitate resource allocation decisions, okay? So when we look at these resource allocation decisions, we are not only talking about the financial resource allocation, okay? We also talk about the resource allocation, the allocation of, let's say, human resources, okay? So all sorts of resources allocation decision, okay? Now, for an entity to be a reporting entity, okay, it should have users who will depend on the general purpose financial reports, okay? So we have to develop or we have to establish that the users will depend on these financial reports to make their economic decisions, okay? So how do we actually define or how do we actually determine whether the dependent users exist? We need to consider a number of things, okay? So first of all is the separation of ownership and control, okay? So if the ownership of a firm and the control is separated, okay, then you'll have the owners who normally is not a controller of the firm depending on who will make that decision depend on what the controller is giving to them. Making sense? So for example, let's say we have a small family business, let's say a noodle house, okay? And it's owned by your mom and dad. Okay, so your mom and dad, your dad, let's say, is the manager, is also the chef, okay, and also the owner of the noodle house, okay? And your mom, because it's so close related to your dad, so your mom probably is a shareholder, okay, to the noodle house, but your mom's decision will not be depending on the general purpose report because your mom and dad, let's say, both control the noodle house. Making sense? So you don't have anyone else will make that decision, that investment decision, depending on the general purpose financial report. So probably only you, your mom and dad will care how this noodle house is performing. Okay? But if we change the firm to, let's say, a listed corporation, a very big corporation, okay, where the company has thousands of shareholders, okay, and these shareholders are separated from the daily decision-making process of the corporation, right? Because the corporation is run daily by the management team, okay? So the shareholders are the owners, but they don't know how the firm is performing unless the management release information in the general purpose financial report, okay? So whether to invest or not, for these shareholders, their decision is dependent on what they see in the general purpose financial reports. Making sense? Yep. So that's the first factor for us to consider, okay? The second one is economic or political importance of entity and potential users, okay? Now this, for the second factor, we are actually talking about a lot of non-corporate bodies or the government-related agencies or government-related corporations or firms, okay? And why is that? If those companies are funded by the government, okay, where do you think the source comes from? The source probably is the taxpayers' money, right? Now, even though the company or these non-corporate bodies, they don't have, let's say, shareholders, okay, but they are using taxpayers' money and then as a taxpayer yourself, you probably want to know how this firm is performing, right? Because effectively you are putting in money to run these organizations, okay? So even though we don't see a separation of ownership and control in those government-related firms, okay, but because these firms using taxpayers' money, so it will have impact to a lot of people, okay? So this is the second factor that we're talking about here, the economic or political importance, okay, of the entity and for the potential users of such information. And lastly, we have to think about the size and other financial characteristics of the firm, okay? Normally, if the company is very big, okay, the stakeholders will be, the base of stakeholders will also be big, okay? And you'll also have more employees. So all of these people, if they don't participate in the daily decision-making process, then the only way for them to assess the company's performance is by reading the financial statements, okay? Happy about this? So this is how we define the reporting entity. Now, as you can see, when we are trying to define who should report, we also talk about who are the users a little bit over here, yeah? So we said these users, if they are dependent on the financial reports, then as an entity who are providing such information, you should be a reporting entity, okay? So we also talk about the users, okay, a little bit in SAC 1. So we still retain SAC 1, okay, after the convergence, just remember that. Now, as you can imagine, once, because we said the conceptual framework is still an ongoing project, right? So there might be one day in future that our SAC 1 is also replaced, okay? But for now, we are still using our own SAC 1. Okay, now, SAC number 2, okay, talks about the objective of financial reporting. So SAC 2 was replaced by the international equivalents in 2013, okay? But before we go to the new SAC 2, well, actually I have it here. We first need to know what is our old stack 2, okay? And you'll see what's the difference between the old stack 2 and the new stack 2, okay? So the old stack 2, okay, defines the objective of financial reporting this way, okay? So they said that general purpose financial reports should provide information useful to users, okay, for making and evaluating decisions about the allocation of scarce resources, okay? So you see I highlight 2 words, right? Information. So it should provide useful information, okay, and to users. Okay, so this is the old stack 2. Now, what's the new stack 2? The new stack 2 says the objective of general purpose financial report is to provide financial information about the reporting entity that is useful to existing and the potential investors, lenders, and other creditors. Okay, so what's the difference between the old and the new stack 2? You look at the information and the users, right? So in the old stack 2, the information, the definition of information is much broader. But in the new stack 2, we said we only consider financial information. So we narrow it down to financial information only. Making sense? So you can imagine when we were actually using old stack 2, the general purpose report should provide financial information, maybe also non-financial information, right? But now, after the amendment, after 2013, we don't need to worry about the non-financial information because we are only required to provide financial information to the users. So that's the first difference, okay? Now, as you can see, moving from a very broad concept of information to a very specific set of information, which is the financial information, we have to change our accounting standards. Yes? Because back then, before 2013, there are some accounting standards that actually talk about the quality of non-financial information, and now these standards will be removed because the conceptual framework has been changed. Does that make sense? Yeah? So that's the first difference, okay? Now the second difference, again, we narrow the definition of users, okay? So in the old stack 2, we said we provide information to users, okay? But it does not spell out who are the users, okay? So it led the accountants, led the company to interpret who are the users themselves, okay? But in the amendment, the users become very specific, okay? So these are the existing and the potential investors, lenders, and other creditors, okay? So if you look at these guys, okay, investors are the capital providers, right? So they are your shareholders, they purchase the share, so they give you money, okay? Lenders and other creditors, they are also the capital providers, right? So they lend you money. So after the amendment, who are the users of the financial statement? These are the potential and existing capital providers, okay? So it's very specific. So what's the difference, okay? So let's say in old days, even though you don't have shares in BHP, let's say, okay? As a student, you don't have shares in BHP, and you don't have this intention to put your money into BHP in near future, okay? But you will still be considered as a user of BHP's financial report. Why? Because you are studying this course and you are required to use BHP's financial information to write an essay, okay? So you are actually considered as a user in the old stack 2. But in the new stack 2, you are not a user because you are not a capital provider. Does that make sense? Yeah? So this is the 2013 amendment. And then last year, we made some other modifications to the objective of financial reporting, okay? So the international equivalent now has been amended again, okay? So what they do is they said we are still providing financial information, so the first amendment is still there, okay? So we change from information to financial information, but then they open up again about the users. So who are the users? It's no longer restricted to the resource provider, even though they said making decisions related to providing resource to the entity, but they do not spell out the investors, lenders, and other creditors. They don't spell out these three parties. Okay, so you consider they actually release a little bit on the definition of users. Okay. So then they talk about the user's decision, right? So the user decision should involve all these things, okay? Buying, selling shares or debt instrument, providing or setting loans and other form of credits, and then voting or otherwise influencing the management actions, okay? So the focus is still on the capital providers, okay? But they do not spell out who are the users in the 2018 amendment, okay? And then the amendment also talks about who are the reporting entity, okay? So the reporting entity is an entity that is required or chooses to prepare financial statements, okay? And they are not necessarily to be a legal entity. It can be a portion of an entity or comprise more than one entity, okay? So the second one over here is saying that you can be a legal entity, okay? But you may not need to you may not need to be a reporting entity, okay? So the example is that a consolidated group, right? So we talk about consolidations in corporate accounting. So within a group, you can have a parent and you can have a subsidiary company, and both companies are legally formed, so that both of them are legal entity, but they only need to provide one set of financial report, so it's only the parent who is a reporting entity. The subsidiary is not a reporting entity, even though it's a legal entity. Making sense? Okay. So this is how the IASB define reporting entity. Now you can see Australian actually does not like this definition, right? So they're still using their own SEC1 that we talked about earlier, right? So this is how we define reporting entity. As you can see over here, we've already talked about that. And this is how the international conceptual work define reporting entity. So Australians decided to go with their old definition, okay? So that's SEC 2. Okay, we still have time. Let's talk about SEC 3, okay? So SEC 3 is about qualitative characteristics of the financial information, okay? So what information is considered to be useful and important? Okay, or for it to be useful and important, what kind of characteristics it should have. Okay, now SEC 3 again experienced a lot of updates. Okay, so let's start with the very original SEC 3, so the one that we had before 2005. Okay, so in our old SEC 3, we said for the information to be for the financial information to be important and useful, okay? It should be relevant and reliable. So what do we mean by relevant and what do we mean by reliable? SEC 3 actually has its own definition, but before we actually go to the definition, so what do we mean by relevant? In your own words. Relevant basically means it has to be related to the decision that you want to make, right? And what about reliable? Yeah, so the information, to be reliable, you have to be able to trust the information, right? So this is reliable, okay? Now, a lot of time, relevant and reliable cannot exist at the same time. So relevance and reliability cannot exist at the same time, okay? So these are the two examples, okay? So the first example, we do not report very relevant information because it is unreliable. Okay, so the example I'm giving you here is the projected cash flows. Okay, so let me expand this example a little bit. Okay, so we talked about capital investment decisions, right? Not sure which unit, maybe 7008. If you remember, for the capital investment decision, you need to calculate the net present value, the NPV calculations, right? So if you have two projects, project A and project B, okay, and you are the investor, you want to put, let's say you have $1,000, okay, and you want to put this $1,000 into one of the two projects, okay, so both projects will last for 3 years. And how do you decide? You need to calculate the net present value of each project, yes? So if the net present value, the NPV for one project is negative, that means you are going to lose money in that project. So it's not a good project, right? So you put your money into the project that gives you a positive NPV, okay? But if both projects give you a positive NPV, you will go with the project with higher NPV, because a higher NPV means higher return for your investment. Making sense? So how do we calculate NPV? We need to know what's the discount rate or the interest rate, right? And we need to then project what is the cash flow in future. So if the project is lasts for 3 years, then we need to know what is the projected cash flow that we think this project will bring us in year 1, year 2, and year 3. Yes? So the projected cash flow is an example over here. Okay? You don't see this account on your financial statement. And why is that? Because even though it's very relevant for your capital investment decision, it's not very reliable. Right? It's projected future cash flow, so it involves estimations. Okay? And this is the estimation provided by the management, and a lot of time the managers may have incentive to inflate the figures. Okay? So even though such information are very relevant for your decision making, but they are not very reliable, so we cannot report them. Okay? Now, the second example talks about the information that can be very reliable, but is irrelevant for your decision making. Okay? So for example, the weight of inventory. Okay? So once again, let's use a simple example. Let me give you a very simple example. If today you walk into a t-shirt shop, okay, and you want to buy a t-shirt, okay, so what are the factors that will influence your decision? For example, the color of the t-shirt, the material of the t-shirt, the price of the t-shirt, but never the weight of the t-shirt, right? So even though the weight of t-shirt, you can measure it, very reliable, okay? You can actually measure the weight of that t-shirt precisely, but this information is not relevant for your decision making because you consider other factors before you actually go to the weight of the t-shirt. Making sense? Yeah? So for such information, once again, in a lot of companies' financial statement, you don't see the weight of inventory because it's basically irrelevant for your decision making. Okay? So a lot of time, we then have to trade off between relevance and reliability. Okay? But the conceptual framework does not provide you any guidance on this trade-off because, as you can see, it's very user-specific. So different users will have different preference, and a different user, even with the same user, they will have different preference at a different time. Okay? So it's really up to you, and this is something that the conceptual framework can tell you. Okay? So reliability. Okay, so this is a formal definition that we used in our old lecture 3. So how do we define reliability? Okay, so reliable information is free from material error and bias. Okay, and can be dependent upon by users to represent faithfully that which it purports to present. Okay, so 3 characteristics in this definition. First of all, the reliable information should be free from material error. And then it should be free from any bias, okay? And lastly, it should be represented faithfully. Okay, so what do we mean by represented faithfully? The provider of such information should not have the intention to mislead the users who are going to rely upon the information. So that's what we mean by faithful representation. Making sense? Yeah? So this is what we have, okay, in old days, okay? Now, I think I'll talk about this now. So after the amendment, okay, the international equivalent removed reliability from the qualitative characteristics, and they only retain faithful representation. They remove the material errors and the bias from the qualitative characteristics. Okay, so a few slides later, okay, over here. So this is the improvement or the amendment made by the United States, okay, on the qualitative characteristics of information, but the new international conceptual framework adopting the same wording, okay? So the fundamental characteristics of information then becomes relevance and faithful representation, okay? So free from error and free from bias is gone. And why is that? Or I guess it's hard to tell why is that, because it's a choice of the standards, right? Standard setters. But what's the consequence, okay, after removing free from material errors and bias from the qualitative characteristics of information? So if you think about, if you are an accountant, okay, and you are sued by the users of the financial statement. So let's say you are sued by one of the party who relied your financial reports, okay? So in the old days, okay, as an accountant, you need to establish that all the information that you provided does not contain material mistakes, okay, does not contain material errors. And you need to establish that you are not biased, right? And you also need to establish that you don't have intention to mislead the users, okay, for you to satisfy, let's say, your due diligence, okay? But after 2013, when we remove the first two characteristics from the definition of reliable information, okay, now it becomes very hard for the users to establish that the accountants actually had the intention to mislead them, because it's probably easier for the users to find material errors or to establish that the accountant is biased, okay? But it's very hard for them to establish that the accountant actually had this intention to mislead the users. So after the amendment, it makes very hard to sue an accountant in a court case. So that's the consequence of this change, okay? So just be careful about that. Now, so this is the fundamental definition of reliability, okay? And then there are other key elements. Some of them may be overlapped, okay? Also support the reliability of the information, and we'll talk about most of them, okay? So the first one, okay, and this is still in the new SAC 3, okay? Substance over form, okay? So for information to be reliable, okay, substance over form is necessary for information to be relevant and reliable, okay? So what is that? So the accounting, okay, accounting for economic substance rather than the legal form is rationale for many accounting treatments, okay? So a lot of time when we look at our accounting treatment, we look at the economic substance. We don't look at the legal form, like, okay? So if you go back to week 1 when we talk about the Enron case, how they treat the SPEs, okay? So they are playing with the legal form. They're playing with the words in the standards or in the rulings, okay? And they ignore the economic substance of those SPEs. So consolidation or equity accounting is one example, and the other example is leases, okay? So I think we mentioned leases in other units, yes? So whether you should classify a lease as an operating lease or a financial lease, right? And a lot of times, people actually misclassify leases, okay, because they're playing again with the legal form, but they're ignoring the economic substance, okay? So that's substance over form, okay? So let me talk about prudence, and then I'll give you 10 minutes break, okay? So prudence, I'm not sure if you heard of that, okay? But another word for prudence is conservatism, and I think most of you have heard of conservatism, right? Because in general, we said as accountants, we are very conservative. And why we are conservative? Because we anticipate all the losses and we never anticipate any gains, right? That's why we are conservative, okay? So prudence is another word for conservatism. And what does that mean in the conceptual framework, okay? In the old SAC 3, it means when you are valuing your assets and income, okay, you need to include a degree of caution, okay, so that your assets and income are not overstated, okay? So another interpretation of this is that you only need to exercise caution, a degree of caution, when you are valuing your assets and income upwards. Does that make sense? It doesn't talk anything about liability and expenses. Yes? So you only need to exercise caution. You only need to be cautious when you are trying to value your assets and the income upwards. Okay? Now, of course, you can. This prudence does not extend to deliberate understatement of assets or income. Okay? But if you look at the concept of conservatism or prudence, okay, we treat assets and the income very differently from the liabilities and expenses, right? So we try to be very conservative about assets, the valuation of assets and income, because we don't want to overstate them, okay? But we can actually be a bit more aggressive when we try to understate asset or income, or while we try to inflate liabilities or expenses. Does that make sense? Yes? So because of this different treatment, okay, or the different approaches to treat assets versus liability, okay, neutrality can never exist. Okay, so it's very hard to explain how neutrality and prudence can simultaneously exist, okay, even though neutrality is one of the key elements for the information to be relevant and reliable. Okay? All right, so I think I will stop here for about 10 minutes, and when you come back, we'll talk about other things. Okay? Okay, so let's start again. Now, before we go to relevance, okay, so we just want to give you an update of what has been going on with the Americans' conceptual framework, okay? Because you see, I talk about the 2013 amendment a lot, right, in the previous slides. This is because the international conceptual framework has been updated, has been amended in 2013, okay? And why is that? Because the Americans amended their conceptual framework first in 2010, okay? And some of the amendments actually influenced the international conceptual framework, okay? So I've already talked about some of them, okay? So for example, they clearly identify who are the users, right, of the financial information, become those who provide resources, equity or debt, okay? And for example, they removed material free from material errors and bias, and reliability, this word, is replaced by faithful representation, okay? And then prudence is not listed as a desirable attribute of information. So these are the major changes in the American conceptual framework, and we also see the same changes in the international conceptual framework. Therefore, our own conceptual framework has been replaced, okay? So that's what happened. Now, one thing that the American did to their original conceptual framework is they update the definition of relevance, okay? And this relevance, the definition of relevance here is important, and we also adopt the same definition, okay, in our own conceptual framework. So what information is relevant? Okay, so information is relevant if it is capable of making a difference in decisions made by users. And so what does that mean? That means the information should have predictive value. Okay, so the information is relevant only when it can help you to predict what is going to happen in future. Okay, and the information is also relevant when it has this confirmatory value. Therefore, the information is relevant when the information can confirm your decisions in the past or your thoughts in the past. Making sense? Yeah? So let me give you an example of predictive value, okay? So I think in week 5 or week 6 when we talk about capital market research, okay, so you will see this from those empirical papers, okay? So a lot of the empirical papers, they research on the predictive value of earnings, okay? And they come with this conclusion, okay? So the current year earnings is 60 or 70% related to your future earnings. Okay, so this has been tested, and this conclusion, therefore, is made by a lot of researchers. Okay, in other words, your current year's earning should help you to predict what is going to be the company's future earnings, because there's a very strong correlation of, let's say, 60 to 70%. Okay, so then we say the current year's earning have this predictive value, so this information is relevant for your decision making if you want to purchase shares of this company in future. If the company currently is doing very well, then very likely, if there's no big things happen to this company, very likely the company's future earning will also increase, right? So this is predictive value, okay? Now, when the earnings, the current year earnings, is not so relevant, when the current year's earning has been manipulated, okay? So if current year's earning has been manipulated, then the correlation with the future year's earning will be very low. Because why? Because whatever massage that you have done to your current year's earning will be reversed in future. So your future earnings will have a very low correlation with your manipulated current year's earning. Okay? So if that's the case, then your current year's earning is irrelevant for your decision. Making sense? Yeah. So this is a predictive value. Okay? Now the confirmatory value is easy to understand. Okay, so if you look at a company's financial statement, it gives you 2 years, right? 2 years financial numbers. And if you compare these 2 years numbers and the last year's numbers and the current year's numbers, and you look at the current year's earnings, let's say, it should confirm your decisions that you made in the past in the company. Does that make sense? Yeah? So it will tell you whether your expectation of the company's performance in the past is actually is actually correct or wrong. Okay, so the financial statement actually by itself provides relevant information to help you to predict future and to help you to confirm the past. Okay? And this is how the Americans define faithful representation. Okay, it should be complete, it should be neutral, it should be free from error. Okay, now free from error doesn't mean it's also free from bias. Okay, and the free from error also does not mean perfectly accurate in all aspects. Okay, so this is the recent development in Australia, which I've already mentioned. Okay, so we now change our lecture3 as well. So the fundamental qualitative characteristics are relevance and faithful representation. Okay, and then after relevance and faithful presentation, because these are the two fundamental qualitative characteristics. Okay, we also have some secondary qualitative characteristics. Okay, to help the information to become more relevant and more reliable. Okay, so what are they? They are comparable, verifiable, timely, and understandable. Okay, so comparable is very easy to understand, right? So it should be the financial reports should be able to compare, right? You should be able to compare the financial reports of one company to another company, and you should be able to compare the current year's financial report with past. Okay, so it's comparable. Verifiable means different knowledgeable and independent observers could reach consensus. Okay, so even though they don't have to completely agree on everything on the financial report, but they can reach a consensus. Okay, and timely means if your financial year end is on 30th of June, then you normally would expect to see the annual reports to be released within 2 months. Okay, so that's timely. And understandable, then, well, the financial report should be prepared so that general investor or the users, the common users, can understand. Okay, so these guys need to have basic level of financial literacy so that they can use the information from the financial reports, but they should be understandable. Okay, the financial reports. Okay, so that's lecture3 about what information is relevant and how do we make the information relevant and reliable. Okay, so now let's have a look at lecture4. Lecture4 is about the nature of the financial statement elements. Okay, so lecture4 covers the definition and the recognition criteria for these 5 financial statement elements. Okay, so I think you all know what are these 5 elements, right? If you don't know that, I'll be very worried. Okay, so we also talk about the definition of the 5 elements in the past. Okay, so I'll go through the definition very fast later on, but what I want to emphasize here is definition criteria is very different from recognition criteria. Okay, and the recognition criteria is something we haven't actually touched. Okay, so let's go through the definition criteria first for each of the elements. Okay, so for assets, right, there are it should have future economic benefits. It should be controlled by the entity. It should be result from a past transaction. Okay, so we all know that. So what we probably haven't talked about is what do we mean by future economic benefits? Okay, so to be more precise, how do we define the benefits? Okay, so the benefits, okay, can result from ongoing use, not necessarily a value of change. Oh, okay, so the benefits that you can generate from your asset, okay, can be result from ongoing use. So, for example, you have your laptop and you use your laptop for 3 years. Okay, so every year you are actually getting the benefit from this laptop. Okay, so from ongoing use, from your income generating activity. Okay, it can also be resulted from a value of exchange. So, for example, you sell your car, your second-hand car, to someone else. So you exchange a car for something else, for cash, let's say. Okay, and the benefits can come from either of them, or it can come from both of them. Okay, so you can use your laptop for 3 years and then you sell the laptop. Okay, So it's the benefit that we care about, okay, in the definition. But we don't care so much about the source of the benefit. So where does the benefit come from? Okay, as long as the benefit is coming from a legal source, okay, then where it does come from is actually not a big problem. So that's benefit. Okay, so we talked about this already. So the benefit will generate cash in future, or it can prevent future payments, okay, that would otherwise be made. So now we are talking about this bit over here, okay? So the future benefit of, let's say, of this quality control equipment, okay, is actually preventing faulty goods, okay, in the future. And how do they do that? Because this equipment is there to control the quality of your products in the production, process, okay? So if you, without this equipment, your faulty rate probably will be very high, okay? And when your faulty rate is high, then you'll have a high warranty claims in the future by your customer. So to avoid that, the company purchased this quality control equipment to reduce the faulty rate, therefore to prevent future payments, okay, future compensation payments. So this is the benefit that this quality control equipment that can bring you, even though it's not in cash term, okay? Now, the characteristics of control, okay? So when we talk about control, so control relates to the capacity to benefit from the asset and to deny or regulate others' access to the benefit. Okay, so what do we mean by that? Let me give you an example, okay? So in order to give you lecture, okay, I need to breathe fresh air, okay? Now, I enjoy the benefit from the fresh air, right, because I can give you the lecture. So, and this is related to my income-producing activity, right? Now, is the fresh air, do I control the fresh air? I don't, right? Because I cannot deny your access to the fresh air, so I don't have control over air. Okay, so the fresh air is actually a public good, therefore nobody can control it. Okay? So that's how we define control. Okay? Now, the legal enforceability is never a prerequisite for establishing the existence of control. Okay? So for example, I have a rental apartment. Okay? And even though I'm not the legal owner of the apartment, I can deny the access request from my agent. Okay? So for example, my agent wants to inspect the apartment. He or she needs to write to me before I allow the access to the property. Okay? So for that sense, I control the rental apartment even though I'm not the owner within the lease term. Making sense? Yep. So this is how we define control. Okay? So legal enforceability is never a prerequisite. And then our past transaction should be easy to understand, right? So we don't have to talk about that. Now, for the liabilities, we use the same definition of the benefit, okay? And for the present obligation, it has to be your obligation, okay? And it has to be your obligation today, okay? It cannot be your future obligation, for example, okay? So when we talk about obligation, the obligation can be in the form of in the form of cash. It can be in other forms, for example, to provide future service, okay? And equity, we know that it's the difference between assets and the liabilities, okay? Now, you can define equity as a residue interest, okay, because it's pure residue calculation. Okay, revenue. Revenue is defined as increases in equity except from contributions by owners. Okay, so if we look at owner's equity section on the financial statement, right, you'll have capital, right, share capital, and you'll have retained earnings, and you'll have other reserves, right? So share capital is contribution made by owners, so that's not your revenue, okay? And other reserves are related to, let's say, assets revaluation or other things. It's not your revenue, okay? And retained earnings, okay? Retained earnings is actually related to your revenue because the increase in the retained earnings must be attributed by the revenue that you earned in the current year, right? Because the increase in retained earnings is actually your current year profit. And how do you derive your current year profit? Your current year profit is derived from the revenue, okay? So revenue, therefore, is defined as the increases in equity except from the contributions made by owners, okay? So if you look at the definition of revenue, okay, so it's what we defined in our old Stack 4, right? But remember, in 2005, we replaced old Stack 4 with the international equivalent, right? So how does the international equivalent define revenue? Revenue is still revenue, but the revenue is not what we had earlier, okay? So in the international equivalent, we have this concept called income, okay? And under income, we then have revenue and gains. Making sense? So this, I think this is what you learned, right? But before, when I was doing my accounting study, I actually only learned revenue, okay? So, yeah, so what do we mean by revenue? In the international equivalent, revenue are those arises in the course of ordinary activities of an entity, okay? And the gains arise from other activities, okay? So again, you probably have heard of this example, okay? Now, as a university, right, what is our source of revenue? Our revenue is tuition fees, right? Because this is our income generating activities. That's our ordinary activities. What is our gain? Our gain might be the profit that we earned if we sold, let's say, Fana Hall to somebody else, okay? So this, the activity to sell one of the property on the campus is not our ordinary activities. It's one-off activity, okay? So the profit that you made from the selling of the property is your gains, but it's not your revenue. Making sense? Yep? Okay. So that's revenue and the gains give you income, okay? And this is not actually a warning. It just, I don't know, just to increase your awareness of how we call the income statement, okay? So we call this statement differently during the different periods. So initially, it was the statement of financial performance. So this is the name we used when I was studying accounting, okay? And then we start to call this statement statement of profit and loss. And now you see in most of the company's annual reports, you see statement of comprehensive income, okay? So we are talking about the same statement. We just use different name, okay? In terms of the revenue and expenses. So that's revenue and expenses, okay? So we'll probably just start from the international framework, okay? So expenses is the other way, is the opposite of revenue, right? So it's, they are the decreases in economic benefits during the accounting period in the form of outflows or depletions of assets or in occurrence of liabilities that result a decrease in equity, okay, other than those related to owner's contribution, okay? So once again, expenses can be split into two subheadings. You can have expenses from the ordinary activities, and then you can have losses from your non-ordinary activities, okay? So that's how we define those 5 financial statement elements, okay? Now, some things are not even mentioned in Stack 4. And what are they? These are the well-accepted ideas on the financial statement elements, okay? So realization, if you read Heinz 1988, that paper talks about realization, okay? But this realization is never mentioned in Stack 4, therefore it's not one of the core assumptions, okay? Matching, you might have heard of matching principle before. So what do we mean by matching? Matching simply means the expense that you incurred has to be matched with your income generating activity. In other words, if you have a source of expense, this expense should be related to one of your revenue generated, okay? So you should be able to establish this link. So this is called matching principle. And once again, it's not mentioned in the conceptual framework, okay? And then conservatism, right? It's not mentioned, okay? So prudence is already removed, okay? And what Stack 4 also didn't do is to address the measurement methods, okay? And Australia wants to leave this to Stack 4, but remember Stack 4 was never released, okay? So measurement issues was never addressed in Stack 4. Okay, so that's about the definition, okay? Now let's talk about the recognition, because recognition criteria is very different to the definitions. Okay, so what are recognition criteria? We talk about two tests, okay, for each element on the financial statement. So the first test is called probability test. The second test is called reliable measurement test, okay? So what is the probability test? The probability test is a test to test whether it's probable that any future economic benefit associated with the item will flow to or from the entity. Okay, so think about that. We talk about the future economic benefit of an asset, right? Because it's one of the definition criteria. Okay, so in the recognition criteria, we want to know how likely that this future economic benefit will flow into the entity. Okay. And the reliable measurement test basically says whether we can actually attach a value, a reliable value, to the item that we want to put on our financial statement, okay? So whether the item has a cost or value that can be measured with reliability, okay? So if an asset or a liability that meets the definition criteria but failed one of these two recognition criteria, it can still not be recorded on your statement. Okay? So everything that you see on the statement meet the definition criteria, and they also meet the recognition criteria. Okay? So let me give you an example. So this is a question taken from your tutorial, okay, for next week. So we have this company, okay, company X purchases a lottery ticket for $1. Okay, so the first prize is $80, and there are 100 tickets to be sold. Okay, but company X only purchased one. So the lottery has not yet been drawn. Okay, so we don't know what's the result. So the first question is, does the lottery ticket conform to the definition of an asset? So if you are company X, do you think you can put this $1 lottery ticket on your balance sheet? Do you think it's an asset for you? Yes? No? Let's go back to the definition of the asset. Over here. So first of all, do you control the lottery ticket? You do control the lottery ticket, right? Because you're company X, so you purchase this lottery ticket. Okay? Does this come from the past transaction? It is come from your past transaction because you purchased it, right? And what about the future economic benefit? Do you have future economic benefit from this lottery ticket? Yes? No? Some of you says yes. Some of you says no. Okay. So how do we define the benefit? We define the benefit this way, right? So can result from ongoing use. It can be a value. Can result from a value of a value in exchange. Okay. So what's the related economic benefit of this lottery ticket? It's the prize that you're going to win, right? The $80. That's your economic benefit. Making sense? So now you look at the definition of an asset, right? So this lottery ticket actually satisfies all these three criteria. But can you recognize this as an asset on your balance sheet? So that's the second question. Would the lottery ticket be recognized on your balance sheet? So now we look at the recognition criteria, the probability test, and the reliable measurement test. Okay? So what we are saying here, for the reliable measurement test, the item has a cost that can be measured with reliability. Do you think the lottery ticket passed this test? Can we value the lottery ticket? So what's the cost of the lottery ticket? It's $1, right? So yes, so the lottery ticket passed the reliable measurement test. What about the probability test? How likely do you think the company will win the lottery, will win the prize? In this case, the company only purchased 1 ticket out of 100 tickets. So the chance of winning is 1%. So now do you think it's very likely to win? So the probability test probably is failed for this lottery ticket. Making sense? So this is an example to show you an item can satisfy all the definition criteria but fail one of the 2 recognition criteria. Therefore, you cannot record it on your balance sheet. Okay? So question C, in what circumstances might your answer to part B change? So how do we increase, let's say, how do we increase the probability of future economic benefit? We just increase the number of tickets that we buy, right? So in this case, the company only purchased 1. So what if I purchased 90 tickets? So then my chance of winning becomes 90%, and so now the probability becomes 90% versus 1%. Yes? So this is how you are going to test an item, okay, whether it's going to be your asset or not. So the probability test, right? So we've already talked about this. Probable is generally considered to mean more likely rather than less likely, okay? So the rule of thumb is that the probability of occurrence is 50% or more, okay? So if, for example, in this case, I purchased 51 tickets, okay, and my chance of winning becomes 51%, then I can justify to myself, right? I can tell myself, yes, now I consider my probability of winning is actually very high because the winning is, the chance is 51%, okay? Because it meets the rule, or it meets the conceptual framework, the requirement of conceptual framework, okay? So the last item here is just a warning, right? So when you record this asset, you record the asset at its cost, okay? You never record the asset at its future benefit, okay? So for example, if your asset initially cost you $10,000, even though you are only 51% likely to get any benefit from this asset, you don't record this asset at 5,100. Okay, you record this asset at 10,000. That's your initial purchase price. Making sense? So I think you all know that. I just want to make sure that you don't mess up. Okay. Now, probability and conservatism. Okay. We talked about conservatism already. Okay. So conservatism basically requires a high probability for assets and revenue, and a low probability for liabilities and expenses. Okay. So that's the probability test, okay? Now the reliable measurement test, okay, can be a problem because remember we said that the conceptual framework has problems with measurement issues, okay? So it comes to the reliable measurement test, we have to decide whether we can measure this item with reliability. Okay, so in Australia we use historical cost accounting, so we actually measure the assets or the liabilities at their initial cost, and this is something can be reliably measured. Okay, but then sometimes measurements are estimates. Okay, so for example, the allowance for doubtful debt. Okay, they are estimates. You don't have a purchase price attached to it, so it increases the difficulty. Okay, in this test. Or sometimes the measurements are current market prices. So for example, if you want to value your shares, right, the share price is normally based on the market price and it's volatile. It changes from minute to minute, okay? So it increases the difficulty of the test, okay? So some of the accounts or items are very easy to be measured, Okay, for some of them, which involve professional judgment. Okay, so for example, allowance for doubtful debt and a depreciation expense. If we have well-accepted estimation methods, then we can still consider this item can be reliable measured. Okay, so if we take depreciation expense as an example, we know the estimation of useful life is very subjective, but if we can agree on that, and we can actually apply formulas, okay, for a straight line method, for example, okay? So these are considered as well-accepted estimation methods, so your depreciation expense calculated from that method can still be considered as a reliable measurement. Making sense? Yeah? So now we talk about the measurement issues, okay, because we're talking about that reliable measurement tests. So we talk about measurement a lot. In fact, when you look at the information that we put into the financial statement, everything on the financial statement is a result of measurement. Yes? So what do we mean by measurement? So this guy, Stevens, in 2046, said measurement is actually the assignment of numerals to objects or events according to rules, okay? So you assign numbers, okay, to the items that you want to measure, okay, according to some rules. So in the context of, let's say, physics or chemistry or those hard science, it's actually very easy for you to do the measurement as long as you have the rules. Okay, and you can also tell whether the measurement is precise or not, whether it's contain error or not, because the rule is very clear, right? But in accounting, it's very difficult because we can't agree on what rules that accounting should apply. Therefore, we have different types of measurement, different measurement methods, okay, in accounting, in practice. And I think I mentioned this last week. Each measurement method is just a different view of the user in terms of how they think they should measure a particular item, right? So the different methods actually represent different views, and these different views has no right or wrong answers, okay? So measurement and truth in social science, therefore, it's very hard to say or very hard for us to assess the accuracy of a measurement, but this is possible in the hard science. Okay, so that's what we are saying on these slides. So what do we do in accounting, right? Some accounts, as I mentioned last week, can actually be measured easily. So for example, the cash and bank account, okay? This account can be relatively easily measured. Why? Because you can actually go to the bank account and you can count the deposits, right? So it's very objective. So you can actually say there's a certain balance in the cash account, regardless of people's opinion, right? As long as we agree $1 note is $1 note, right? Some other accounts, when they involve estimates or when they involve professional judgment, then they are very difficult, okay? They can be very difficult. So, can we compare measurement of different properties? The answer is very hard, okay? Can we say the market value of an asset is a better measure than the asset's written down value? Again, it's very hard because different methods represent different views, and if you choose one method over another method, you have different incentives, right? So let me give you a very easy example. Okay, so we are looking at the Winter Olympic Games, okay, in 2010 and 2006, not 2016, okay? So we want to assess the achievement of different countries, or 4 countries actually, by looking at the gold medal strike rate, okay? So this is my stats, okay, 2010, 2006. I have 4 countries, and if I look at the gold medal strike, okay, and I compare 2 years' performance, Australia is doing very well, yes? So the strike rate was 50% in 2006, but it increased to 67% in 2010. So if I use this measurement, I can say Australia is probably one of the best, right? Using this measurement. Happy about this? First of all, 67 ranked as the highest in 2010. And secondly, if you compare your past performance with your current performance, you see an increase. So the performance increased. Okay, so it's a good thing for Australia. If I change my measurement, I don't look at the strike rate, I look at the actual number of the gold medals each country obtained in the games. Then my answer will be different, right? So Australia is not the best performer. Who will be the best performer? If we look at the gold medal in 2010, Canada is the best performer. And Australia, in fact, is a bottom performer. So my conclusion is very different if I use a different measure. Yes? Now, if I look at the total medals, right? If I look at total medals in 2010, who's the best performer? US is the best performer, and Australia, once again, is the bottom performer. Okay? So look at this example, right? If I choose one of the three different measurement methods, my purpose is different. Yes? So I have different incentive behind each of the methods. So if I go with the rate, I want to say Australian was the best performer, right? If I want to say, okay, I want to say Canada is the best performer, I will go with the gold medal numbers. If I want to say US is the best performer, I go with the total medals. Okay? So different measurement for the same thing, okay, for the same numbers, okay, same stats, you can have different interpretations because your incentive is different. Okay? So we talk about the problem with market value measures. Okay, so if we are talking about shares, right? So the measurement of shares is always difficult. Why? Because share value is very volatile. Okay, but volatile market price do not prevent reliable measurement. Okay, in fact, if you look at the financial statement, every financial statement you have the headings, right? And the heading tells you this is a financial statement as at a point of time. Okay, so the balance sheet measurement is taken at an instant in time. Okay, therefore, we cannot say the market price is not reliable simply because it changes very quickly. Okay. All right. So last few minutes, let's talk about the current valuation or the current measurement system that we are using in Australia. We'll come back to this in week 11 and 12, okay? So in Australia, I think most of you already know that, right? So when we measure assets or liabilities, we use a modified historical cost system. And why do we call it modified historical cost system? Because all the assets, they are initially brought to account at their costs. Right? So, for example, when you purchase a TV, you use the purchase price as the initial cost of the TV. Yes? And then we modify this historical cost. Okay? So to the extent that the service potential of asset declines over a reporting period, depreciation is charged. Right? So if the TV is used by 3 years, then every year we deduct depreciation from the depreciation cost from the original cost. So we get a net book value of the TV. Making sense? Yeah. And then some company, if they choose to revalue their asset, they are permitted in Australia. So if they believe the fair value or the current market price of the TV increased, they can always choose to revalue their TV to the market value. Okay, and then after revaluation, the depreciation will be calculated based on the revalued price, right? So this is what we call a modified historical cost system, and this applies to all the assets and the liabilities. It applies to both tangible assets and intangible assets. Okay, so all the depreciation, amortization, or impairment, these are the modification to the original historical cost of the asset that you initially recorded. Making sense? Yeah? Now, we do have other measurement models, okay? And in the later lectures, you'll see how we do calculations under these 3 different measurement models, okay? Once again, there's no right or wrong in terms of these alternative measurement models. They're just different incentives behind it, okay? So I think that's all for this week, and start from next week, we're going to talk about positive accounting theory, okay?